Hey everyone! The Bureau of Labor Statistics recently released the employment numbers for March, and in and of themselves they look pretty good. According to the BLS, 178,000 jobs were added for the month, which would be the strongest monthly addition since December of 2024. However, we also know that the first release of the jobs numbers each month have been getting revised downwards, sometimes significantly. Although the U.S. economy continues to expand at a moderate pace, with GDP growth of about 2.1% in 2025 and a similar gain expected in 2026, job creation has been minimal. Over the last year, the U.S. has created an average of about 22,000 jobs per month, including the outsized number for March. To put that number in perspective, in 2024, the U.S. created an average of nearly 122,000 jobs per month. That's 100,000 more jobs each month on average. And in 2023, the average was about 210,000 per month. So the pace of job creation has slackened considerably. Taking a deeper look at the data, almost all of the job creation has been in the healthcare sector. Aside from healthcare, there's been nominal job creation in local government as well as leisure and hospitality sectors. But despite the weak pace of job creation, the unemployment rate has remained relatively stable, with March coming in at 4.3%. This has largely been driven by a 60 basis point year-over-year decline in the labor force participation rate to 61.9%. That drop in participation was partially driven by people 55 and over, where the participation rate fell by 100 basis points. But the bigger reduction was in the participation by young adults between 20 and 24 years old, which fell by 140 basis points. And the slowing pace of job creation, together with the weakening labor force participation by young adults, has restrained multifamily housing demand. Now, the preliminary numbers for the first quarter of 2026 suggest there may be a bounce in apartment demand, but in 2025, there was a dramatic drop-off in apartment absorption in the second half of the year. Net new units filled in the first half of 2025 averaged 191,000 units per quarter. But in the third quarter, apartment demand fell to just 35,000 units, and in the fourth quarter, there was a net loss of 40,000 units absorbed. And that loss of momentum reflects the weakened labor market faced by young adults. Not only are fewer young adults participating in the labor force, but the unemployment rate of young people has risen as well. And as a result, the number of young adults living with family has risen to its highest level on record, even higher than it was during the pandemic, the last time we saw a surge like this. Now, the silver lining in this metric is that historically, when young adults have moved in with family, it has been on a relatively temporary basis. In the 2 years following the pandemic, the number of young adults living at home declined by nearly 2 million, fueling a significant wave of apartment demand. In 2021, about 665,000 net new units were absorbed. And although there was a modest retrenchment in 2022, apartment demand surged in 2023 and 2024, filling a combined 880,000 apartment units. So, once the employment market restabilizes and more young adults begin to find career track jobs, apartment demand should quickly gain momentum. Now, for the other property types, the impact of the slower pace of hiring has been less noticeable. Office space absorption has been positive for 7 consecutive quarters through the end of 2025. Primary markets captured more than 53% of the absorption, outpacing the 20% share gain by secondary markets and the 26% that was added in tertiary markets. And over those 7 quarters, suburban office was favored, capturing 63% of the absorption compared to the CBD office. From a quality perspective, Class A space dominated, capturing more than 71% of the new space filled, while Class B and C offices participated in just 29% combined. Now, thus far, the slackening pace of job creation has had little effect on retail or industrial space demand. The tariffs have likely had a much more telling effect on these two property types, so it's difficult to parse out the actual impact of the employment market. That said, space demand for both retail and industrial was healthy in the second half of 2025 after dipping into negative territory briefly as the tariffs came into play. So, the one commercial real estate property type experiencing headwinds from the weakened employment market is multifamily. Office, retail, and industrial space demand appears to be steady. But looking forward, the demand for multifamily housing hasn't been lost, it has just been postponed. And that pent-up demand will continue to grow until the job market strengthens, and at that point, we could see a significant surge in apartment absorption. And when that happens, it will dramatically shift the multifamily performance metrics and potentially property values. And getting ahead of that structural change will be a key for investors who keep their eyes on the horizon.